Have you ever looked at a stock chart and just seen chaos? Well, today we're diving into a fascinating theory that claims to have cracked the market's code. It's called the Elliott Wave Theory, and it suggests that underneath all that noise, there's a hidden, predictable rhythm just waiting to be found.
So that really is the million-dollar question, isn't it? Are the financial markets just a series of random, unpredictable movements, or is there some kind of hidden order to it all? For nearly 100 years now, one theory has been arguing that the chaos we see is really just an illusion.
And that brings us to this guy, Ralph Nelson Elliott. Back in the 1930s, after pouring over 75 years of stock market data, this American accountant made a pretty bold claim. He said he'd discovered the market's secret blueprint, a repeating rhythm in all the noise. So here's the core of Elliott's big idea. He believed that markets aren't just driven by earnings reports or breaking news. No, he said they're actually a reflection of the natural, rhythmic ebb and flow of human psychology, but on a massive scale. This quote right here really nails it. Elliott was convinced that the constant swing we see in society, between collective optimism and pessimism, between greed and fear, creates these repetitive, predictable patterns in price charts. Those emotions, he argued, are the real market drivers. Okay, so if there's a hidden rhythm, what does it actually look like? Well, Elliott found that every single market move, whether it's happening over decades or just a few minutes, is built from one fundamental structure, what he called the 5-3 pattern. And this whole theory really just boils down to two basic types of waves. First, you have impulse waves. These are the ones that push the market in its main direction. And second, you have corrective waves, which are the pullbacks that go against that trend. That's pretty much it. Now, when you put these two wave types together, you get what Elliott called a complete market cycle. According to him, one full cycle always has 8 waves, a 5-wave impulse move followed by a 3-wave corrective move. And that is the famous 5-3 pattern. Let's break down those impulse waves, waves 1, 3, and 5. Think of them as the action waves. Wave 1, that's the initial spark, usually started by smart money investors. Wave 3 is the big one, where the public finally catches on and jumps in, making it the longest and most powerful move. And then Wave 5, well, that's often the last gasp of euphoria as the latecomers pile in. And then, of course, you have the corrective waves. These are basically the market catching its breath. Waves 2 and 4 are those smaller pullbacks within the main trend, where people are just taking some profits. But that larger ABC pattern, that's the major correction that follows the big 5-wave push, representing a real shift in market sentiment. So how do you keep from just seeing patterns that aren't really there, seeing what you want to see? Well, Elliott knew this was a problem, so he established 3 unbreakable rules to keep the analysis objective. To be a valid impulse wave, a pattern must follow them. All right, here they are, the 3 crucial rules. Number 1. Wave 2 can never retrace more than 100% of Wave 1. I mean, think about it. If it did, that initial optimism would be totally gone. Number 2, Wave 3 is never the shortest of the 3 impulse waves. It's the heart of the move, it has to show real power. And number 3, Wave 4 can't overlap with Wave 1's price territory. This keeps the integrity of that first big push. Simple, but absolute.
And this is what turns the theory into a discipline. If a wave count breaks even one of these rules, it's invalid. Period. You have to throw it out and start over. It provides a strict, objective framework for your analysis.
But Elliott didn't stop with just psychology and patterns. He claimed that this psychological rhythm actually has a mathematical signature, one that connects human emotion to a very famous number sequence. So we know the engine behind all this is the constant battle between greed and fear, right? That surge of optimism and greed is what drives those powerful impulse waves upward. And then the inevitable return of fear and uncertainty is what causes those choppy, sideways corrective waves. And here is where it gets really interesting. Elliott noticed that the length and depth of these waves weren't random at all. In fact, they were often related to each other by a very specific mathematical ratio. That's right, the golden ratio. This number, which comes from the Fibonacci sequence, appears everywhere in nature, from seashells to galaxies. And Elliott claimed it also governs the proportions of the market's waves. Now, this is where the theory becomes a potentially practical tool. Analysts use these Fibonacci relationships to project possible price targets.
For instance, they might look for wave 2 to pull back about 61.8% of wave 1, or for that powerful wave 3 to extend 1.618 times the length of wave 1. It's almost like a mathematical roadmap for where the market might be headed.
So we've got the pattern, we've got the rules, and we've got the math. But the biggest question of all remains, does any of this actually work? And that brings us to the great debate that still surrounds this theory today.
Out in the real world, you'll find plenty of professional analysts who use Elliott waves every single day. They're out there mapping potential future price paths for just about everything. Stocks, commodities, you name it, using these wave counts to frame their forecasts and manage their risk.
And yet, the criticism is fierce. Supporters will tell you it provides an invaluable framework for understanding the market and it instills discipline. But critics fire back that it's way too subjective. Two analysts can look at the exact same chart and see two totally different patterns. Plus, there's no hard scientific proof that it can actually predict the future.
This quote really gets to the heart of it all. Even its strongest advocates will tell you that Elliott wave analysis gives you probabilities, not certainties. It is definitely not a crystal ball. Its success seems to depend almost entirely on the skill and experience of the analyst using it.
So what's the bottom line here? Well, at its very best, the theory gives you a structured way to think about market behavior. It's a method for building a narrative around price action, a story based on the collective mood swings of millions of investors.
Which leaves us with one final fascinating question to think about. Did Ralph Nelson Elliott really discover a map of the market's collective mind? Or is applying his theory just a very sophisticated way of seeing familiar patterns in random clouds? The debate, for sure, is far from over.